Now let's talk about exchanging. The last time I think we had you in the show, we talked about, and this was actually a couple we met with who were thinking about selling their home in Marin County. They had a huge amount of equity, and still big money, obviously, in Marin County, in San Francisco, and where people are looking about maybe exchanging in Sonoma County, because right now our prices relative to San Francisco and Marin are bargains. They've always have been, but now they're even more of a bargain. And they probably read that Money Magazine article and said, hey, let's go get that 6% return right away up there to Santa Rosa. And people are just calling me like crazy. By the way, my number, but you need to give myself or Allison a call, and that's 322-8503. Put that on the air, Alan, 322-8503. But say we have somebody in Tiburon overlooking the straits and all that kind of good stuff, and the place is worth, God, $2 million easy, right? So now they're going, okay, we have all this equity. We're going to sell it. Now, they're going to get hit with taxes. So what would you, because we talked about the strategy last time, how they could do this. They could, move out, make it into a rental? So why don't you explain that to us?
Well, this is a revenue procedure that came down that has a use for some people if they're willing to go through the mechanics.
Right.
And this is a time when somebody is actually selling a primary residence,
Right.
and they have a large gain. In the scenario we were talking about before, this couple had bought the property originally in Belvedere for about $500,000, and at the time they were ready to sell it, it was worth about $2 million.
Right.
Now, the way you figure capital gains tax is you give them a benefit of that $500,000 that they paid for the property originally, and when they sell it, because they are a couple under the Section 121 exemption, they get another $500,000 exemption. So in their case, they had about $1 million worth of gain, or they would have been paying about $250,000 in capital gains tax.
Ouch.
For some reason they didn't want to pay that.
I don't. Let me ask you guys a question. We'll take a poll. How many people want to pay $250,000 to the IRS? Okay, Joe. No, sorry. Okay, that was Big Rinzani. No.
That would be a big no.
Yeah.
So what they could do if they were willing to do this is they can convert the home to an investment property for a period of time.
Okay.
And their intention when they do this must be to hold it for investment purposes.
Right.
So they rent it out for maybe a year and a half, 2 years, and then they go to sell it. And as long as they sell it within 3 years, they would still qualify under Section 121 as having owned it for 2 of the previous 5 years.
So they get their $500,000.
So they can sell it and take their primary residence exclusion, and they can exchange the rest of the gain into an investment property.
Is that still valid?
Yes, it's still valid.
Wow.
And in that event, they would be able to sell the home without paying any capital gains tax. So this is good for empty nesters.
This is good. This is just good. I get a warm, fuzzy feeling when I talk about that.
Well,
I'm just going, wow. That's so nice.
It is nice, and
of course, we all had a place in Tiburon worth a couple of $1 million, but but it has different applications. Though. I mean, we're not necessarily talking $2 million, but a lot of people have that situation where there still is a lot of equity in Sonoma County, and a lot of people that have large estate properties, and this is a tax strategy you really got to consider.
Well, it's certainly something to consider planning wise, and I've seen some situations where it wasn't even a strategy. It was just that people had moved out, rented the house, they'd been traveling around the country, and now they were getting ready to sell it and recognized that they would have a big gain, and it was a perfect fit for them.
Yeah. And, it's that's not considered a step transaction where they're actually, or would it be considered a step transaction?
It could if it was shown that the intention was to
not pay the IRS any money.
That's why it's important that your intention be to convert it strictly to an investment property for a period of time.
Yeah, you just can't leave it vacant for 2 years, and you must make an attempt to rent it out. And so you probably want to get a property manager in there and really go through the steps of renting that property out.
Yeah, and in some situations what I've heard of is setting up a long-term lease option.
Oh, okay. All right.
Which would... if there's a long-term lease option, that would convert it to an investment property.
Okay, interesting. Okay,
for a period of.
We're talking 1031 tax-deferred exchanges, and that last scenario was very interesting because there are still other wealth-building strategies out there, or we should say asset preservation strategies, and we're talking about vacation homes. What's going on with those? Are you seeing anything there? Is that viable still?
Well, certainly vacation homes are viable, and what's interesting to note is that the IRS actually came out with a revenue procedure that put in place safe harbor provisions for when a vacation home is exchangeable. And in this marketplace right now, there are situations where people do have vacation homes, and maybe it's not as cost effective right now to have them strictly as vacation homes. Maybe they need to get some income out of that asset. So what the IRS looks at is they look at the 24-month period before you sell a vacation property,
Right, okay.
or the 24-month period after. And in both circumstances, they break it down into two 12-month periods of time, and they want to see that somebody has rented out the property at fair market rent in each 12-month segment for at least 14 days. That's it.
That's it.
Yeah.
14
it's
days?
14 days.
Wow.
Now, they also restrict personal use, and they say that you can use the property for up to 14 days or 10% of the time that you rent out the property, whichever is greater. So minimally, somebody can use the property for 14 days in a 12-month period. And if they rent it out for a longer period of time, say 200 days, they could have, say, 20 days personal use. And then there is an ability to go to the property for maintenance visits
Yeah, right.
to the
right,
property. But what happens right now, or what we are seeing happen, is some vacation homes are being sold and they're being exchanged into income-producing assets.
Yeah, they're realizing that we can't afford that little vacation home in Aspen, so we need to get some income going.
Right.
And perhaps they were keeping it as, like you say, 14 days they'd run it out, then the rest of the time they'd use it, but they were going, that's no longer viable, and they want to get something closer to home. So at that point, they would exchange that property into a property here.
Right, where they would see maybe a cash flow circumstance, since
Exactly.
real estate's starting to make more sense
Yeah,
again.
yeah. Maybe get some better deals here. Okay, so there's opportunities out there. So, and the thing you need to do is have a really sharp CPA that can advise you on this. Okay, or in your agent can do just so much for you, but you really need to have a sharp CPA that really knows real estate.
I think that's really important, because otherwise you're paying somebody to learn
Yeah,
on the
exactly.
job.
Yeah.
So sometimes if people don't have a CPA who specializes in that, there's a way to consult with somebody who does specialize in that arena.
Right.
And maybe they can consult with their particular CPA as well.
Yeah, exactly.